Hello, everyone. Today, we're going to dissect an intriguing phenomenon that has shaken one of Asia's financial giants, the Hong Kong Stock Exchange. On the agenda, zombie companies and market maneuvers that have caused quite a stir. But what lies behind these terms that seem straight out of a suspense movie? How have seemingly lethargic entities become key players behind the scenes of a vibrant and competitive market? In the next few moments, we will shed light on the intricacies of this saga and reveal the underpinnings of a financial story that has rocked investors and questioned regulators. So stay with us to learn more about this fascinating tale where reality and surprise go hand in hand. And if you enjoy content like this, don't forget to subscribe, hit that like button, and turn on all notifications so you don't miss our upcoming video. The Hong Kong Stock Exchange, a glittering financial jewel in the heart of Asia, has long embodied the vigor and opulence of a booming economy. Towering with its gleaming skyscrapers, it stood not just as a business hub but also as a symbol of Asian modernity and success. Investors, businesses, and economists worldwide turned their gaze to this market, known for its dynamism and as a crossroads for international capital. Indeed, bodies such as the Hong Kong Securities and Futures Commission and the Hong Kong Monetary Authority were often cited as guarantors of this financial integrity, ensuring that the market remained a competitive and safe platform for global trade. These regulatory bodies, with their strategic vision, helped shape the exchange's reputation as a place where financial tradition and modernity meet, providing fertile ground for innovation and investment. Historically, the Hong Kong Stock Exchange has been the stage for the integration of East and West, a place where age-old trade traditions met the fast pace of modern finance. The listed companies represented a range of sectors from traditional manufacturing to cutting-edge technology, reflecting the diversity and resilience of the Hong Kong economy. The exchange also mirrored the region's ambitions and confidence in the future. Each IPO, each trade, each record set was a celebration of shared prosperity and a testament to Asia's economic health. Business-friendly policies, attractive taxation, and balanced regulation forged an environment where investors could expect attractive returns, while companies benefited from easier access to capital. Yet, beneath the shiny veneer of numbers and charts, an insidious problem began to creep in. It was almost by chance that the first cracks appeared in plain sight, with anomalies in financial reports and unusual trading volumes for some companies previously unnoticed by the general public. Indeed, reports published by renowned credit rating agencies like Moody's and Standard & Poor's began to highlight discrepancies in some companies' financial statements, signaling anomalies that warranted closer attention. These early warning signs, though discreet at first, were the harbingers of a darker reality. The so-called zombie companies, commercial entities surviving on debt rather than real revenue, began to proliferate. Their presence was initially a whisper, background noise easily ignored. Yet, their impact on the market was significant. These companies, by their mere existence, began to erode investor confidence, a pillar of any financial market. The initial repercussions were like ripples on a lake's surface, spreading slowly but inexorably. Financial analysts began to raise eyebrows, investors to ask questions, and regulators, particularly those from Hong Kong Exchanges and Clearing Limited, to scrutinize the books more closely. In this environment of heightened vigilance, HKEX took steps to strengthen oversight and adjust policies, striving to preserve the exchange's reputation as one of the most respected in the world. The phenomenon could no longer be regarded as a series of isolated cases. It had become the symptom of a potentially broader and more destructive disease. Thus, in a complex economic ballet, each market player had to position themselves in face of this new reality. Some chose ignorance, others vigilance. The most seasoned investors began to read between the lines of balance sheets, searching for truth, while the less experienced found themselves caught in the trap of too good to be true high return promises. In this context, the story of the Hong Kong Stock Exchange and its zombie companies gradually became a captivating narrative, not only for market players but also for the general public. Curiosity turned into concern, concern into a quest for answers. How could such a phenomenon develop? What were the flaws that allowed these entities to thrive in the shadows? To address these central questions, we need to delve into the details of how zombie companies emerged and proliferated in Hong Kong. The phenomenon subtly developed, fueled by a period of rapid economic growth where abundant capital was seeking new investment opportunities. During this growth surge, some essential verification practices were overlooked, allowing zombie companies to slip through the cracks of an otherwise robust system. The gaps that allowed these companies to thrive lay in a combination of lax regulations, insufficient oversight, and a market mentality focused on growth at any cost. Additionally, the internal control mechanisms of companies, which should have detected and prevented risky practices, were often inadequate or overlooked. External auditors, supposed to be the last line of defense against misleading financial statements, sometimes missed early warning signs of financial instability or failed to alert the market and regulators with the necessary urgency. When these issues were finally brought to public attention, the reaction was swift and unforgiving. Informed investors reacted with increased skepticism, often triggering massive sell-offs of the implicated companies' shares and severe market corrections. Regulators followed by imposing investigations and reforms, aiming to fill the gaps that had allowed such drift. Since then, the revelation of these issues has caused a chain reaction, affecting not only investors but also everyday life in Hong Kong. Stock market fluctuations, amplified by the Zombie Company scandal, had tangible impacts on employment, pensions, personal savings, and consumer morale. The involved companies were forced to rethink their strategies, sometimes leading to layoffs or deep restructurings that directly impacted employees and their families. In this context, the media took hold of the story, dissecting every new revelation, stock fall, and regulatory announcement. Experts voiced their opinions in talk shows, in-depth articles were published, and social media buzzed with speculation and theories. It was no longer just a matter of numbers and rates, it had become a question of trust and integrity. As the investigation progressed, revealing the scope and depth of questionable practices, a clearer picture began to emerge. Audit reports exposed flaws in oversight and governance. Shareholder meetings were tinged with tension as difficult questions were asked and authorities were pressured to act. And as the world watched, the gears of financial justice began to turn. Thorough investigations were launched, leading to hearings, parliamentary debates, and even legislative reforms. Each step taken seemed a move towards restoring balance and reassuring a market shaken by doubt. The actions taken by the authorities sent ripples across Hong Kong's financial landscape, heralding an era of imminent change. The legislative reforms, in particular, marked a decisive step in the institutional response to the crisis. Stricter laws and clearer guidelines were established, not only to penalize past offenses but also to prevent future deviations. As the reforms took shape, companies had to adhere to higher standards of financial disclosure. Audits became more frequent and rigorous, and the consequences for fraudulent management were significantly strengthened. This overhaul led to a real introspection within companies, forcing them to assess not just their accounting practices but also the long-term viability of their business models. At the same time, attention turned to educating investors, urging them to become more informed and skeptical of quick return promises. Seminars, workshops, and online platforms flourished, offering valuable resources to understand market intricacies and the implications of new regulations. The consequences of these changes were palpable. Indeed, the Hong Kong Stock Exchange showed tangible signs of progress, better transparency for listed companies and a renewed push towards investments based on solid foundations. However, this positive picture should not overshadow the necessary caution. As the market strives to regain eroded trust, it moves forward with a renewed awareness of risks, forging its resilience in the reality of an ever-evolving financial landscape. Committed to a path of transformation, the Hong Kong Stock Exchange is evolving, drawing lessons from the past to shape its future. Financial institutions, armed with experience, remain vigilant, knowing that a truly healthy market is one that continues to question, innovate, and adapt. In this dynamic of learning and evolution, the exchange is rebuilding itself, not by returning to what it was, but by aspiring to what it must become. Thus, the Hong Kong Stock Exchange stands as an example of a market's ability to recover after a scandal, while retaining the wisdom gained during these turbulences. This delicate balance between consolidating achievements and cautiously navigating towards the future now characterizes its identity. It distinguishes itself by its ability to assimilate lessons, optimize risk strategies, and enhance vigilance, all while highlighting that maturity and adaptability are invaluable assets for any institution, regardless of its history or longevity.